Imagine you have just been promoted. You are the newly minted chief financial officer of like a massive American tech manufacturing firm.
Oh, congratulations. Big step up.
Right. Huge step up. And, you have just closed this brilliant, highly profitable quarter in your European division. Like sales are up 20%, your margins are incredibly tight, and your operational efficiency is just the envy of your competitors.
Sounds like a dream quarter, honestly.
It is. But then a week later, by the time your accounting department actually, translates those millions of euros back into US dollars so you can report your quarterly earnings to Wall Street, well, a sudden, completely unexpected 3% shift in the currency markets has just entirely wiped out $50 million of your profit.
Ouch. Yeah, just gone.
Literally vanished into thin air. I mean, you didn't lose a single customer. You didn't mismanage a single supply chain, but your profit is just gone, and your company's stock price just tanked by 10%. So, yeah, welcome to the terrifying, completely borderless reality of international finance.
Yeah, it is. It's a brutal wake-up call, right, for anyone transitioning from domestic management to the global stage. Because, in a purely domestic setup, you are operating in a closed system.
Oh, right. It's safe.
Exactly. You set your prices in dollars, you pay your suppliers in dollars, you pay taxes to the IRS, and your risk is generally just confined to the domestic economic cycle. But the exact second you cross a border, you are not in a closed system anymore. You're stepping into an arena where, like, macroeconomic forces that you literally cannot control, maybe a central bank decision in London or some sudden regulatory shift in Mumbai, they can fundamentally alter the mathematical viability of your business overnight.
And if you are listening to this right now, you are likely in the final stages of your MBA, and you're preparing to step into exactly that kind of arena. I mean, you have probably been staring at Unit 14, right? Financial management for multinational corporations.
Oh, yeah. The notoriously dense chapter.
So dense because it basically forces you to synthesize everything you have learned about corporate finance and macroeconomics and global strategy all at once. So our goal today on this deep dive is to, just strip away the textbook dryness. We want to build a truly functional mechanical understanding of these systems for you.
Yeah, we are going to build the actual mental frameworks you need, so that when you sit down for your exam, you aren't just, sweating and trying to recall memorized definitions. You will actually be able to visualize exactly how the machinery of global finance turns.
Because moving from just route memorization to genuine, mechanical comprehension is really the only way to master this material.
Absolutely. If you understand the underlying why and the how, why an instrument was even created in the first place, or how a risk physically manifests on a balance sheet, then the definitions, the whats, they just naturally fall into place.
Right. You can logically deduce the answer to complex exam scenarios because you actually understand the physics of the market.
Exactly.
So let's start with the largest piece of machinery on the board, which is the global capital market. If we define it purely technically for the exam, it is an interconnected web of financial institutions that allows individuals, corporations, and governments to trade financial instruments internationally, completely unconstrained by geography.
Yeah, no borders whatsoever.
Right. We are talking about the buying and selling of long-term debt, short-term debt, and equity across borders. But, let's look at the actual physics of this. Who is physically pushing this money around, and why are they doing it?
Well, it basically comes down to a structural imbalance between surplus and deficit. On one side, you have entities with just massive, massive amounts of surplus cash. We are not just talking about a wealthy individual's checking account here.
Right, not a savings account.
No, we are talking about colossal pools of capital. Sovereign wealth funds managing the oil revenues of entire nations, or gigantic tech corporations sitting on hundreds of billions in retained earnings, and of course, massive non-bank financial institutions like pension funds and insurance companies.
And they have a fiduciary duty to generate a return on that capital, right? They cannot just leave it sitting in a vault somewhere.
Exactly. If they leave it in a vault, inflation would just erode it to nothing. They are desperate for yield. So they are constantly, actively hunting the globe for the best possible return, adjusted for risk.
Okay, so that's the surplus side.
Right. And then on the exact opposite side of the spectrum, you have the borrowers who are operating at a massive deficit. These are rapidly expanding multinational corporations that need billions to build, say, a new semiconductor fabrication plant in Taiwan, Or developing governments that need to finance massive new hydroelectric dams or railway networks. They need the capital today so they can generate growth tomorrow.
And the global capital market is simply the matchmaking service between the two, like the pension fund in Frankfurt that needs a steady 4% return and the infrastructure project in Brazil that needs $500 million right now.
That's a perfect way to look at it. Matchmaking.
But, they don't just call each other up directly, right?
Right.
You have the intermediaries sitting right in the middle, the commercial and investment banks. They package the Brazilian debt, they rate the risk, and then they sell it to the German pension fund, taking a pretty substantial fee for structuring the deal.
And that matchmaking process creates immense advantages. This is a really critical point of analysis for anyone studying this field for the exam. Let's look at the mechanics of those advantages.
Break it down.
For the borrower, let's say it's a medium-sized enterprise in South Korea. If they are restricted to borrowing only from South Korean banks, they are totally subject to the limited supply of capital in that one specific country.
Right.
But by accessing the global market, they are suddenly tapping into planetary liquidity. The supply of available money is just exponentially larger. And following basic economic principles, when the supply of an asset, in this case capital, massively increases, the price of that asset goes down.
And the price of capital is just the interest rate. So the ultimate advantage for the corporate borrower is a significantly lower cost of capital. I mean, they get to fund their expansion way more cheaply than if they were trapped inside their domestic borders.
Yes, exactly. Now, flip the perspective to the investor. Their primary advantage is portfolio diversification.
Crucial concept.
Super crucial. If that German pension fund invests exclusively in the German domestic economy, their entire portfolio is highly correlated, meaning if Germany enters a severe recession, all their assets drop in value simultaneously. But if they spread that capital across U.S. tech equities and Brazilian infrastructure bonds and Japanese government debt, they are massively de-risking their portfolio.
Right, because a localized shock in one region gets absorbed by the stability of all the others.
Ex-
But let's test that logic for a second. Because if you look at the history of global finance, diversification isn't like some magical, impenetrable shield. The interconnectedness of this market seems to create its own unique, terrifying vulnerability. I know the textbook refers to this as the contagion effect.
Oh, yes, the contagion effect.
Because we are not just sharing capital, right? We are sharing risks.
You are absolutely right, and understanding the mechanics of contagion is just vital for the exam. The global capital market assumes that information flows perfectly and that actors behave completely rationally. But when those assumptions break down, you get severe systemic instability. Contagion is basically the dark side of a hyper-connected system, and the absolute clearest mechanical example of this is the 2008 financial crisis.
Yeah, let's break down exactly how that contagion physically moved, because it started as a totally localized issue in the United States housing market, right? We have this massive proliferation of subprime mortgages, which are basically high-risk loans given to individuals with pretty poor credit. And then these loans were packaged together by U.S. investment banks into these complex financial instruments called collateralized debt obligations, or CDOs.
And because of that global capital market we just described, those U.S.-based CDOs weren't just sold to U.S. investors. They were highly rated by credit agencies. So they looked like incredibly safe, high-yield investments to the rest of the world.
Right. Everyone wanted them.
Everyone. So they were purchased by those intermediaries you mentioned, commercial banks, pension funds, municipalities all over Europe and Asia. So that the hyper-localized risk of a single homeowner defaulting in Nevada was secretly resting on the balance sheet of a commercial bank in London or, a regional bank in Germany.
Wow. So when the U.S. housing bubble finally burst and those homeowners started defaulting massively, the value of those CDOs just plummeted to near zero.
And this is where the contagion mathematically accelerates, because it creates a global liquidity freeze. The bank in London realizes the CDOs on its balance sheet are suddenly toxic waste. But what's worse is they don't know how much toxic waste the other banks are holding.
Oh, right, because they all lend to each other.
Exactly. Banks rely on lending to each other overnight to maintain their required capital reserves. So suddenly, trust just evaporates. The London bank absolutely refuses to lend to the German bank. The flow of credit simply stops.
And when credit stops, the real economy just suffocates. Like a shipping company in Greece suddenly can't get a routine short-term loan just to fuel its vessels, simply because the banks are hoarding cash to cover their U.S. mortgage losses.
Yeah.
I mean, the contagion literally leaped from a housing default in Nevada, straight through a complex financial derivative, across the Atlantic, into the European interbank lending market, and finally crashed into the daily operational budget of a Greek shipping firm. That is the vulnerability of a completely borderless market. Like capital flight in one node of the network instantly starves another node.
Which is exactly why understanding the sheer scale and velocity of this market is so critical. To anchor this for your exam analysis, consider the baseline data from Hill's 2009 study, which perfectly captures the explosion of this market leading up to that era.
Let's hear the numbers.
The numbers are just staggering. In 1990, the global stock of cross-border bank loans was around $3,600 billion. By 2006, that had expanded nearly fivefold to $17,875 billion.
Wow.
The international bond market mirrored this too, leaping from $3,500 billion in 1997 to over $17,500 billion in 2006. And international equity offerings, meaning companies issuing stock across borders, went from $18 billion to $377 billion in that same short window.
I mean, numbers like that do not just happen organically. You don't see a 500% increase in an entire global financial sector without some fundamental structural change in the environment. So what actually engineered this massive explosion? What tore down the walls between these domestic markets?
There were really three distinct interlocking catalysts that you need to know. The first one is technological. The advancement in information communication technology, or ICT.
Okay, ICT.
Right. Think back to the 1980s. Moving millions of dollars between Tokyo and New York required massive administrative overhead, physical telex machines, time delays. But the advent of secure, high-speed global fiber optic networks and advanced data processing, it just completely collapsed the time and cost of transactions.
It essentially created a market that literally never sleeps. It's like a continuous 2047 relay race of capital. Tokyo opens, trades are executed based on the previous day's U.S. data, then Singapore and Hong Kong join the volume. As Asia winds down, Frankfurt and London open up, digesting the Asian close. And as Europe reaches its afternoon, Wall Street rings the opening bell.
Exactly.
Because of ICT, capital can continuously chase these little micro-arbitrage opportunities around the globe without a single second of downtime.
Perfect description. Now, the second catalyst is the broader macroeconomic trend of globalization. This is the integration of the world economy into a single, highly interdependent marketplace. As trade barriers fell through agreements like the WTO and supply chains became incredibly globalized, designing in California, sourcing in Africa, assembling in China, the capital required to finance that trade naturally had to become globalized as well.
Right. You can't have hyper-efficient international supply chains financed by hyper-fragmented, localized, inefficient banking systems. Capital flow just had to expand to meet the demands of global trade.
Exactly. And the third catalyst is regulatory. Governments made the deliberate, conscious decision to just get out of the way. We call this deregulation. It began aggressively in the late 1970s and 1980s in the United States and the United Kingdom, and then subsequently spread to Japan, France, and eventually emerging markets. Governments systematically began dismantling their capital controls.
Okay, let's unpack that, because we need to define what a capital control actually is, just to understand why removing it was so explosive.
Good point. Historically, if a foreign investor wanted to buy a massive stake in a domestic company, or if a domestic citizen wanted to move $1 million to a Swiss bank account, the government heavily restricted it. They taxed it or outright banned it, mostly to protect their domestic currency value. Deregulation basically meant stripping away those quotas, removing the punitive taxes on foreign investment, and allowing the free flow of quote-unquote hot money in and out of the country.
But let's look at the fallout of that deregulation for a second. Because if opening the floodgates is supposedly the ultimate driver of growth, why do we see emerging economies today being incredibly cautious about removing their final capital controls? Like, if free-flowing capital is the goal, why the hesitation?
It goes directly back to the volatility we discussed earlier. Think of an emerging economy as a relatively small, shallow swimming pool, and the global capital market is an ocean.
Okay, I like this analogy.
If you completely remove the barrier between the two, and the ocean decides to flow in, meaning global investors suddenly love your growth prospects, that massive influx of foreign currency can actually cause severe domestic inflation. It can artificially spike your real estate prices, and cause your own currency to appreciate so rapidly that your exports become totally uncompetitive globally.
And I imagine the reverse is even more dangerous, right?
Exactly. The moment global sentiment shifts,
Mm-hmm.
say the U.S. Federal Reserve just raises interest rates, that ocean of hot money instantly flows out of your shallow pool and back to the safe haven of the U.S. That sudden, massive capital flight can literally collapse your banking system and aggressively devalue your currency overnight.
Wow.
Therefore, modern financial management in developing nations often involves what we call macroprudential policies, essentially smart, targeted regulations to allow stable, long-term investment in, while keeping up heavy guardrails against the destructive volatility of short-term speculative capital.
So we have established the architecture of this global network, right? We know the catalysts that built it, and we can visualize the sheer volume of money sloshing through the fiber optic cables. But what exactly are these institutions buying and selling?
The instruments.
Yeah, the instruments. We need to look closely at the actual items on the shelves of this 247 supermarket: global equity and global bonds. Understanding the precise mechanical differences between these two is the absolute foundation for analyzing a multinational's capital structure on your exam. Let's break down equity first.
Sure. When we talk about equity, we are quite simply talking about stocks. The fundamental mechanism you must understand here is that issuing equity means selling a fraction of ownership in the enterprise. If a multinational issues 1 million new shares, they are slicing up the ownership pie into smaller pieces and selling those new pieces to the public.
And because the investor is now an owner, their risk profile is uniquely positioned, right? Equity represents a residual claim on the firm's future cash flows, and that word residual is critical.
Very critical.
It means there are absolutely zero guaranteed payments. The company has no legal obligation to pay you a dividend. If the company goes bankrupt and liquidates, the equity holders are at the very back of the line, receiving whatever is left over only after the banks, the bondholders, and the suppliers have been made whole.
However, because they bear the maximum risk, they also capture the maximum upside. If the company develops a revolutionary new technology and profits skyrocket by 1,000%, well, the bondholders' interest payments do not change at all, but the equity holders' share value absolutely explodes.
Now, historically, an American company issued equity on the New York Stock Exchange, and a Japanese company issued on the Tokyo Stock Exchange. But the current trend we are seeing is the aggressive internationalization of corporate ownership. Companies are deliberately crossing borders to list their stock on foreign exchanges.
Right.
Why go through the massive legal and regulatory headache of complying with a foreign country's securities commission just to list your stock?
It is a highly strategic maneuver driven by 3 primary objectives. First, and honestly most obviously, liquidity. By listing on a massive exchange like London or New York, a company from a smaller market suddenly gains access to a vastly larger, deeper pool of institutional capital.
Makes sense.
Second, it is a currency matching strategy. If a European company has massive operations in the United States, their revenues are in dollars. By listing their equity in the U.S., they can raise capital in dollars, which naturally hedges their operational exposure.
Oh, that's smart.
And the third objective.
Talent acquisition and retention. If you are a French multinational trying to hire top-tier software engineers in Silicon Valley, you need to offer competitive compensation, which usually means stock options. It is significantly more attractive to a U.S. employee to receive stock that trades easily on the NASDAQ in dollars, rather than receiving equity that's locked up on the Euronext Paris exchange and denominated in euros. Right, nobody wants that headache. Okay, so let's contrast the ownership model of equity with the debt model of the global bond market. Because when you buy a bond, you are not buying a slice of the company. You are acting as a lender. You are extending a loan to the corporation or the government.
And the mechanics of that loan are rigidly defined by a contract. A bond has a specific maturity date, say 10 years from now, when the principal amount must be returned in full. And it provides a fixed income, meaning the issuer is legally obligated to pay a specific interest rate, known as the coupon, at very regular intervals.
And because of that legal obligation, bonds are fundamentally lower risk than equity. If the company defaults on a bond payment, the bondholders can literally force the company into bankruptcy proceedings to seize assets and recover their funds.
Yes.
Furthermore, from the corporation's perspective, debt financing has a massive structural advantage. The interest payments they make on those bonds are generally tax-deductible expenses. This creates what we call a tax shield, which effectively lowers the true cost of borrowing.
Here is where the mechanics get intricately specific for anyone studying this field, though. Because on the exam, you will inevitably need to definitively distinguish between the two primary categories of international bonds. And I warn you, the terminology here is notoriously counterintuitive. We need to clearly separate foreign bonds from euro bonds.
Oh man, this is the classic exam trap.
It really is. Let's define the parameters of a foreign bond first. There are two conditions that must be met. A foreign bond is issued by a borrower in a country that is not their home country. And D, crucially, the bond is denominated in the local currency of the country where it is being sold.
Okay, so if an American corporation wants to raise capital in Japan, they issue a bond in Tokyo, and that bond is denominated in Japanese yen. Or a German company issues a bond in New York, and it is denominated in US dollars.
Exactly. And the financial industry loves giving these specific foreign bonds little nicknames. Foreign bonds sold in the U.S. are called Yankee bonds. Foreign bonds sold in Japan are samurai bonds. Foreign bonds sold in the UK are bulldog bonds. But the core mechanic remains the exact same. Foreign entity, local currency.
Okay, now let's look at the Eurobond, which is where the confusion usually starts. A Eurobond completely divorces the currency from the geography. A Eurobond is typically structured and underwritten by a massive international syndicate of banks. The defining characteristic is that the bond is denominated in a particular currency, but it is sold in markets outside the country of that currency.
Right, and let me emphasize this. The prefix euro has absolutely nothing to do with the European Union or the euro currency.
Wait, really? Nothing at all?
Nothing at all. In this context, euro simply means external or offshore.
Okay, I think we need a mechanical analogy here to lock this distinction into your memory for the exam. Let's think about a corporation traveling to a foreign country as a person traveling abroad, and think of the currency they use as the language they choose to speak.
I like this.
If you issue a foreign bond, it is like an American business executive traveling to Paris and conducting all their meetings in fluent French. You are a foreign entity, but you have adopted the local language, the local currency. That is a Yankee bond or samurai bond. You conform to the local standard.
And issuing a euro bond is like that exact same American executive traveling to Paris, but stubbornly insisting on conducting all their meetings in US dollars, meaning American English or perhaps even Japanese. You are completely outside your home borders, but you are carrying a foreign language with you. You are keeping the currency external to its home nation.
Exactly. So a euro-dollar bond is denominated in US dollars, but it is sold to investors in London or Singapore or Frankfurt. A euro-yen bond is denominated in Japanese yen, but it is sold outside of Japan.
So why do companies use the Eurobond market so heavily? Like, why complicate the currency geography at all? Primarily, it is an exercise in regulatory arbitrage.
Dodging the rules.
Essentially, yes. Because Eurobonds are offered internationally and not within the jurisdiction of the currency's home country, they often bypass incredibly stringent national regulations. For instance, a Eurodollar bond issued in London does not have to be registered with the U.S. Securities and Exchange Commission, which saves the issuer massive amounts of time, disclosure requirements, and administrative costs.
So we have mapped the terrain of the global capital market, and we have inspected the primary instruments, equity, and bonds. The next logical step is to really step into the shoes of the multinational's chief financial officer. They have this massive 247 global supermarket of capital available to them. How do they actually formulate the recipe for their funding?
That's the million-dollar question.
And more importantly, once they have the money, how do they mathematically justify spending billions to build a facility on the other side of the planet? This leads us directly into Section 3, capital structure and international capital budgeting.
Right. So the foundational decision a CFO makes is determining the firm's capital structure. This is the exact proportional mix of debt, equity, and hybrid securities that a company uses to finance its assets and operations. If a company has a capital structure of 30% equity and 60% debt, the CFO has carefully calibrated that specific ratio to balance risk and cost.
And how does that differ from working capital? Because, those terms often get conflated by students.
Yeah, they do. So capital structure is the long-term permanent financing architecture of the firm. Working capital, on the other hand, is the day-to-day short-term liquidity. Mathematically, it is simply current assets like cash, inventory, and short-term receivables minus current liabilities like accounts payable and short-term debt.
So it's basically your daily survival money.
Exactly. Working capital dictates whether you can survive the month. Can you make payroll? Can you pay the supplier in Taiwan for the microchips that arrived yesterday? If your working capital management fails, your brilliant long-term capital structure doesn't matter at all because the company will be insolvent by Friday.
So the CFO is managing the daily liquidity while simultaneously tweaking the massive long-term capital structure. Now, we mentioned earlier that debt is cheaper than equity because of the tax shield and the lower risk to the investor. So why doesn't a CFO just finance 100% of their company with debt? Why issue equity at all if it's way more expensive?
Because of the crushing weight of financial distress. The more debt you stack onto your capital structure, the higher your fixed interest obligations become. As your leverage increases, the risk of default rises exponentially. If a global recession hits and your revenues drop by 30%, but your debt obligations remain rigidly fixed, you will quickly bleed through your working capital and face bankruptcy.
Oh, that makes sense.
Right. And therefore, as a firm takes on more and more debt, bondholders demand higher and higher interest rates to compensate for that increased risk of default.
And eventually, the cost of that new debt just becomes so prohibitively high that it outweighs the tax benefits entirely.
Exactly. The CFO is constantly searching for the mathematically optimal capital structure, the exact point where the blend of debt and equity minimizes the firm's overall weighted average cost of capital, or WACC. By minimizing the cost of their funds, they maximize the value of the firm.
All right, let's say the CFO has optimized the WACC. They have raised $2 billion at a very efficient blended rate. Now they actually have to deploy that capital. This is the realm of capital budgeting. It is the rigorous quantitative process of evaluating potential long-term investments. Like, are we acquiring a competitor in Brazil? Are we building a new lithium refinery in Australia?
And while there are several metrics used, like internal rate of return or the payback period, the absolute gold standard for capital budgeting is net present value, or NPV.
Yes, let's break down the actual mechanics of an NPV calculation because it is the ultimate truth teller for capital allocation on your exam. NPV is built on the foundational concept of the time value of money, which is basically the undeniable fact that receiving a dollar today is intrinsically more valuable than receiving a dollar 5 years from now.
Right, due to inflation and the opportunity cost of not being able to invest that dollar in the interim.
Exactly. So the math of NPV is ruthlessly logical. Step 1. You calculate the massive initial cash outflow required to start the project. Let's say $500 million to build the Australian refinery. Step 2. You forecast every single cash inflow and outflow that project will generate over its expected operational life, let's say 20 years. Step 3 is where the time value of money comes in. You take those future cash flows and you discount them back to their value in today's dollars.
And what number do you use to discount them? Use the firm's cost of capital, that WACC we just discussed, adjusted for the specific risk of the project. If you are financing the project with capital that costs you 8%, you must discount the future cash flows by at least 8%.
Right.
Finally, step 4. You sum up all the present values of the future cash flows, and you subtract the initial $500 million cost.
If the final resulting number is positive, it means the project's returns exceed the cost of the capital used to fund it. The project mathematically creates wealth for the shareholders, and the CFO greenlights it. If the NPV is negative, the project destroys value, and you just walk away.
It's a brutal calculation.
It really is. Now, running an NPV for a domestic project is complex enough. But when you apply capital budgeting internationally, the complexity multiplies exponentially. Why do companies willingly subject themselves to this headache?
The strategic drivers for international expansion generally fall into 3 categories. First, market seeking. The domestic market might be fully saturated, so the firm hunts for new consumers in emerging economies just to maintain their growth.
Okay.
Second, efficiency seeking. This usually involves relocating production to regions with significantly lower labor costs or more efficient regulatory environments. And third, resource seeking. The physical reality that critical raw materials, like rare earth minerals for electronics, are only geologically available in specific foreign jurisdictions.
But the moment you decide to build that facility in a foreign jurisdiction, you have to drastically alter your NPV calculation. You cannot simply use your domestic discount rate. You have to mechanically inject the volatility of the outside world directly into your math. The sources we're reviewing highlight 3 massive international risks that must be accounted for.
Let's look at the first one, foreign exchange risk. We will dive deep into how to physically hedge this later. But in terms of capital budgeting, how does a CFO model currency volatility over a 20-year project life?
Yeah, how is that even possible?
It directly attacks the cash flow forecasts. You might project that the Australian refinery will generate 50 million Australian dollars a year, but your shareholders only care about US dollars. If you forecast an exchange rate that remains static, your NPV will be wildly, dangerously inaccurate. CFOs have to run complex Monte Carlo simulations, basically stress testing the NPV against dozens of different currency depreciation and appreciation scenarios over the next 2 decades.
Wow. And the second massive variable is taxation risk. Stepping across a border means stepping into a total labyrinth of host country corporate tax rates, withholding taxes on dividends remitted back to the parent company, and incredibly complex bilateral tax treaties.
The complexity here cannot be overstated. A multinational has to forecast not just the stated tax rate today, but the trajectory of fiscal policy in that country over the project's entire lifespan. Furthermore, they have to navigate the incredibly contentious realm of transfer pricing, which is the prices at which different divisions of the exact same multinational charge each other for goods and services across borders.
And to illustrate just how volatile jurisdictional tax issues can be, our source material highlights two very prominent historical examples. The first involves Apple and the complex structure of their profits housed in Ireland regarding European Union tax jurisdictions. The second involves Vodafone and a massive retroactive tax dispute with the Indian government over the acquisition of a domestic telecom asset.
Now, to be exceptionally clear here,
Yes, very clear.
we are examining these cases purely as mechanical examples of regulatory friction. We are impartially reporting the existence of these disputes exactly as the financial literature presents them. We are absolutely not commenting on the ethics, the legality, or the political validity of either the corporate tax strategies employed or the regulatory actions taken by the respective governments.
Right. That is the exact correct analytical lens for your exam. For a CFO running an NPV calculation, the political morality of a tax law is totally irrelevant. The mathematical impact of a sudden, retroactive billion-dollar tax assessment is literally everything. It is a catastrophic shock to the forecasted cash flows. It demonstrates that tax environments are dynamic, aggressive variables, not just static numbers on a spreadsheet.
Which perfectly bridges us into the third and perhaps most difficult variable to quantify: political stability. You are analyzing the risk of a host government radically shifting its foreign investment policies, initiating capital controls, or in extreme cases, experiencing civil unrest that results in the complete expropriation or nationalization of your physical assets.
Right, and if I am the CFO, I understand how to mathematically adjust my discount rate for inflation or interest rate shifts. But how on earth do you quantify the probability of a geopolitical crisis 5 years from now? How do you put a hard number on the threat of a government seizing your factory?
You do it by fundamentally altering the discount rate, specifically by adding a sovereign risk premium. If your baseline WACC is 8% and you are building in a highly volatile region, you might add a 400 basis point premium, pushing your required discount rate up to 12%.
Let's trace the math on that. By increasing the discount rate in the denominator of the NPV equation, you aggressively shrink the present value of all those future cash flows.
Exactly. The math demands that the project be overwhelmingly, undeniably profitable in its raw cash generation, just to break even against that heightened level of risk.
But, relying purely on a mathematical risk premium feels incredibly passive to me. Like, if the government actually seizes the facility, your NPV instantly drops to zero, regardless of what your discount rate was. Do multinationals just accept this risk and hope for the best?
Absolutely not. They actively engineer risk mitigation directly into the operational architecture of the foreign subsidiary. They use strategy to lower the required risk premium. Our sources detail 3 distinct methods for this. First, they aggressively localize their executive management. By hiring host country nationals to run the operation, they embed the company into the local economic fabric, making it much harder for a populist political movement to paint the subsidiary as a hostile foreign extractor.
That's brilliant.
Second, they engage in highly visible, strategic corporate social responsibility initiatives. They build local schools, they fund infrastructure, they improve regional water quality. This is not just philanthropy. It is political armor. They are intentionally raising the political cost for any government official who considers attacking their operations.
And the third mitigation strategy is arguably the most structurally effective.
Yeah.
The joint venture.
Yes. Instead of entering the foreign market as a wholly owned subsidiary, the multinational partners with a powerful, deeply connected local corporation. They share the equity and the profits.
Let's look at the mechanical genius of this. If an American company owns 100% of a copper mine in South America, A new political regime might score really easy political points by nationalizing it. But if that mine is 50% owned by the largest domestic conglomerate in that South American country, well, nationalization means the government has to directly attack and destroy the wealth of its own domestic business elite.
Yep.
The joint venture acts as an incredibly effective human shield against political risk.
So the CFO uses the math of NPV to identify the risk and the operational strategy of joint ventures to neutralize it.
All right, let's move forward in the timeline. The CFO has run the Monte Carlo simulations. The NPV, even with the sovereign risk premium attached, is strongly positive. The political risk is mitigated by a joint venture. The board of directors officially approves the $2 billion expansion.
Green light.
Green light. The immediate logistical question becomes, where exactly do we acquire the specific foreign currencies required to pay the local construction firms and suppliers? It is time to open the international wallet and examine the specific sources of funds for MNCs.
Right. Multinationals utilize a whole spectrum of funding sources, ranging from traditional lending institutions to highly complex specialized securities. Let's cover the traditional foundation first.
Okay, traditional first.
The primary engines are the global commercial banks. These institutions have massive foreign exchange reserves, and they provide the bespoke, short to medium-term foreign currency loans required for localized operational execution.
And then, working alongside the commercial banks, you have a completely different tier of lenders, international agencies and development banks. We are talking about institutions like the World Bank, the International Finance Corporation, the XM Bank, and the Asian Development Bank.
The critical distinction here is their underlying mandate. Commercial banks lend strictly to maximize shareholder profit based on risk-adjusted returns. Development banks, however, were established by consortiums of national governments. Their primary mandate is to facilitate international trade, stabilize global economic growth, and fund vital infrastructure in developing regions.
So they play by slightly different rules.
Right. Therefore, they often provide long-term capital, and sometimes even subsidies or grants, to projects that might be deemed slightly too risky or too long-term for a traditional commercial bank to stomach.
Now, we need to transition into the highly specialized instruments. In global finance, and especially on this exam, you are going to encounter an absolute barrage of acronyms. It can look like total alphabet soup. But each acronym represents a very specific mechanism for moving capital across a border while navigating regulatory friction. Let's dissect them mechanically, starting with the ECB.
Okay, ECB. It stands for External Commercial Borrowings. Now, context is super important here. In the framework of the source material provided, this refers specifically to a financial instrument deeply ingrained in the Indian regulatory system. It is the formal mechanism by which Indian corporations and public sector undertakings are permitted to access foreign money from non-resident lenders to finance their commercial activities.
The crucial point of analysis here for the student is understanding exactly where an ECB sits on the balance sheet.
Yes, an ECB is strictly a debt instrument. It is a loan. The Indian company is borrowing foreign currency and committing to a fixed repayment schedule.
Okay.
This must be fundamentally contrasted with FDI, foreign direct investment. FDI is an equity transaction. If a foreign entity engages in FDI, they are buying an ownership stake in the domestic company. An ECB allows the domestic company to access massive foreign liquidity without diluting their ownership or surrendering an ounce of voting control to foreign entities.
Okay, that's clear. ECB equals pure debt, no loss of control. Let's move to the next instrument, which is structurally fascinating. The ADR. The American Depositary Receipt.
The ADR.
Let's set up the problem the ADR actually solves. Imagine you are a highly successful Japanese robotics company. You want to raise capital from the deepest pool of liquidity on Earth, American retail and institutional investors. But American investors generally do not want to go through the massive administrative hassle of opening a Japanese brokerage account, converting their dollars to yen, and dealing with the complex tax implications of owning direct foreign shares. There is simply too much friction.
And the ADR completely eliminates that friction. Here's the exact mechanism of how it works. A massive U.S. financial institution, let's say a major custodian bank, purchases a massive block of shares of the Japanese robotics company directly on the Tokyo Stock Exchange. The U.S. bank takes those physical Japanese shares and places them securely in their vault. Then the U.S. bank turns around and issues receipts against those vaulted shares. These receipts, the ADRs, are then listed directly on a U.S. exchange, like the New York Stock Exchange.
And to the American investor, the ADR looks, walks, and talks exactly like a normal domestic stock. It is priced in U.S. dollars. It trades during normal U.S. market hours.
And crucially, the dividend mechanics are handled seamlessly. When the Japanese company pays a dividend in yen, the U.S. custodian bank receives it, translates that yen into dollars at the current exchange rate, takes a tiny administrative fee, and deposits the dollars directly into the American investor's brokerage account.
Okay, let's use a mechanical analogy to visualize this, because this is going to be on the exam.
Go for it.
Buying an ADR is like walking into your local American grocery store to buy imported Italian Parmigiano Reggiano cheese. You, the consumer, do not have to fly to Italy. You do not have to negotiate with the dairy farmer in Italian. You do not have to convert your dollars to euros, and you don't have to deal with customs or import taxes. The massive grocery store acting as the custodian bank has handled all the complex cross-border logistics, the packaging, and the currency translation. You just walk down the aisle and buy the cheese in dollars.
That is a perfect analogy.
Right. The ADR allows the capital to cross the border without the investor ever having to leave home.
It highlights the exact value of the intermediary. Now let's expand that concept globally with the GDR, the Global Depository Receipt.
Okay, GDR.
A GDR operates on the exact same underlying mechanism as an ADR. A custodian bank holds the underlying domestic shares and issues receipts against them. But while an ADR is specifically targeted at the U.S. market, a GDR is designed to tap into multiple international markets simultaneously.
So a company in Brazil might issue a GDR that is simultaneously listed and traded on the London Stock Exchange, the Frankfurt Stock Exchange, and the Singapore Exchange.
Precisely. GDRs are aggressively utilized by rapidly expanding companies in emerging markets who need to raise capital on a truly global scale. There are a few subtle operational differences you should remember. While ADRs are heavily traded by everyday retail investors in the U.S., GDRs are generally marketed almost exclusively to massive professional institutional investors. Furthermore, a GDR is often denominated in U.S. dollars, regardless of which European or Asian exchange it is trading on, because the dollar remains the undisputed bedrock currency of global wholesale finance.
All right, we have covered the pure debt of the ECB and the equity by proxy mechanics of the ADR and GDR. Let's look at a hybrid instrument, the FCCB, foreign currency convertible bonds.
This is a sophisticated instrument that basically attempts to offer the best of both worlds to the investor. As the name explicitly states, it begins its life as a standard debt security. The multinational borrows foreign currency, and the investor receives a fixed, regular interest payment.
But it is the convertible element that makes it powerful.
Yes. Embedded within the contract of that bond is essentially a financial option. It stipulates that within a certain time frame, the bondholder has the right, or in some specific structures, the obligation, to convert the principal amount of that bond into a predetermined number of pure equity shares of the issuing company or into depository receipts.
Let's think about why an investor would want this. They get the downside protection of a bond, a guaranteed fixed income if the company's stock does absolutely nothing. But if the company uses that borrowed money to build a massive new product line and their stock price triples, the investor can convert their bond into equity and capture that massive upside. It is debt that acts as a cocoon, eventually hatching into equity ownership.
Yeah.
So let's review the position of our hypothetical CFO. We analyzed the global markets. We determined our optimal capital structure. We calculated a positive NPV for our expansion project. And we have successfully utilized a strategic mix of Eurobonds, ADRs, and syndicated commercial loans to raise $2 billion in foreign capital. We are heavily capitalized and ready to break ground.
Ready to go.
But there is a ticking time bomb sitting on the balance sheet. If the massive pool of foreign currency we just raised suddenly plummets in value against our operating costs before we can deploy it, our profit margins are instantly obliterated.
And this brings us to the most volatile battleground in international finance. We need to dissect foreign exchange risks and exposure.
Yes, Section 5.
To understand the sheer magnitude of the risk, we really have to look at the physics of the foreign exchange market, universally known as Forex, or simply FX.
Okay, let's talk Forex.
The Forex market is not a centralized building like the New York Stock Exchange. It is a decentralized global electronic network where banks, institutions, and individuals constantly exchange one currency for another. And the sheer scale of it is almost incomprehensible. It is, by orders of magnitude, the largest and most highly liquid financial market in human history. The daily trading volume frequently exceeds $6 trillion. It just dwarfs the global equity markets.
And the participants driving that volume are not just, people buying travel money for a vacation to Spain. We're talking about central banks managing national reserves, massive hedge funds utilizing aggressive leverage to speculate on micro movements, multinational corporations executing global payrolls, and retail algorithmic trading systems executing thousands of trades a second.
Crucially, unlike the stock market, governments are massive, active participants in the forex market. Central banks will aggressively buy or sell their own national currency in the open market to intentionally manipulate its value, trying to hit specific inflation targets or make their national exports more competitive globally.
It is an arena defined by relentless, high-velocity volatility. And for a multinational corporation, that volatility manifests directly as foreign exchange risk. Let's clearly define this mechanism for the student. Foreign exchange risk is the mathematical probability that an asset, a liability, or a forecasted future cash flow denominated in a foreign currency will degrade in value purely due to unpredictable fluctuations in the exchange rate.
Right.
Your engineers could design a flawless product, your marketing team could execute a brilliant campaign, and your sales team could shatter their quotas. The business operations could be perfect. But if the currency moves against you, the financial profit simply evaporates.
Which is why multinationals spend billions of dollars building treasury departments to defend against it. To build a defense, you must first categorize the threat. Financial theory categorizes currency exposure into three distinct types. Understanding the mechanical differences between these three is critical for your analysis. Let's begin with the most immediate threat: transaction exposure.
Transaction exposure is highly specific and short-term. It focuses on individual contracted deals. It is the risk that exchange rates will shift between the exact moment a company signs a binding contract in a foreign currency and the subsequent date when the actual payment is finally settled.
Let's run a mechanical scenario. Imagine an American aviation company signs a contract today to purchase precision engines from a British manufacturer. The contract legally obligates the American company to pay 50 million British pounds exactly 90 days from now upon delivery.
Okay.
Today, the exchange rate is exactly $1 to £1. The American CFO budgets $50 million for the engines. Simple, right?
But the Forex market is volatile. Over those 90 days, the British pound steadily appreciates against the dollar. When day 90 arrives, the exchange rate is now $1.2 to every British pound.
Ouch.
The American company is still legally obligated to pay 50 million pounds. But to acquire those 50 million pounds in the open market today, they must now spend 60 million US dollars. The physical engines haven't changed. The contract hasn't changed. But the transaction exposure just cost the American company $10 million in pure cash flow.
Exactly. It is a realized cash loss on a specific payable. Now let's zoom out and look at the second category, which is far more insidious: operating exposure. This is also known as economic exposure. While transaction exposure looks at a specific invoice 90 days out, operating exposure looks at the long-term strategic earning power of the entire enterprise over years or decades.
It measures how persistent, long-term shifts in currency values alter the fundamental competitive position of the firm. Let's trace a supply chain to see how this physically manifests. Imagine a German automaker. They manufacture their cars entirely in Germany, paying their unionized labor and their local suppliers in euros. But they sell 50% of those cars in the United States, receiving US dollars.
Okay, I see where this is going.
If the euro undergoes a massive multi-year appreciation against the US dollar, that German automaker faces a structural crisis. Their cost of goods sold, the labor and the steel, is priced in a very strong euro, but their revenue in the US is generated in very weak dollars.
And when they translate those weak dollar sales back into euros, their profit margins just compress violently.
And the automaker really only has two choices. They can absorb the loss and watch their profits vanish, or they can aggressively raise the sticker price of their cars in the US to compensate for the weak dollar. But if they raise prices, US consumers will simply switch to buying Japanese or American cars. Their long-term operating exposure has fundamentally destroyed their global competitiveness. It is not about one missed invoice. It is about the mathematical viability of their entire business model.
Precisely. And finally, we must look at the third category: translation exposure. This is fundamentally different from the first two because it does not involve the actual flow of physical cash. It is an accounting risk.
It is the paper risk of consolidating a global balance sheet.
Yes. Let's say an American multinational owns a massive manufacturing facility in Mexico. The physical value of the land, the buildings, and the machinery is tracked locally in Mexican pesos.
Makes sense.
At the end of the financial quarter, The parent company in the U.S. is legally required to consolidate all its global subsidiaries into a single, massive financial statement denominated entirely in U.S. dollars. They must translate the value of that Mexican factory into dollars at the current exchange rate.
So if the Mexican peso has suffered a severe devaluation against the dollar over that quarter, the translated value of that massive factory on the consolidated balance sheet suddenly plummets.
Right.
The factory itself hasn't changed. It hasn't lost a single brick. It is still producing the exact same number of units. There's no operational cash loss whatsoever.
Right.
But on paper, the asset side of the multinational's balance sheet has shrunk massively.
And that paper loss is incredibly dangerous. It negatively impacts the firm's debt-to-equity ratios. It can trigger covenants in their existing bank loans. And when Wall Street algorithms see the firm's total asset value drop, it can instantly trigger a massive sell-off of their stock. Translation exposure is purely an accounting phenomena, but its consequences are very, very real.
Okay, so we have categorized the exposure: the short-term transaction invoice, the long-term operating strategy, and the paper translation of the balance sheet. When a multinational actually steps into the Forex arena to manage these exposures, they face a gauntlet of structural risks inherent to the market itself. Our sources categorize these into 4 distinct pillars. We need to understand how these risks mechanically interact.
The first and most pervasive is exchange rate risk. We have essentially been describing this the whole time. It is the raw, unadulterated volatility of supply and demand causing the spot price of a currency to fluctuate unpredictably from second to second. It is the baseline chaos of the market.
Right. The second pillar is interest rate risk. This is slightly more complex, but it is deeply mechanical. To understand it, you have to understand a fundamental theorem of international finance called interest rate parity.
Let's break that down for the exam. Interest rate parity essentially states that the difference in interest rates between two countries must be perfectly reflected in the forward exchange rate between their currencies.
Okay, give me an example.
If you can earn 5% interest on a risk-free U.S. Treasury bond, but only 2% on a German bond, capital will naturally flood out of Germany and into the U.S. to capture that higher yield. To prevent endless risk-free arbitrage, the forward exchange rate of the euro must mathematically appreciate against the dollar to exactly offset that 3% interest rate differential.
Okay, so how does this actually create risk for the CFO? Because central banks change interest rates unexpectedly. If the U.S. Federal Reserve suddenly hikes interest rates to combat inflation, it instantly alters the mathematical foundation of interest rate parity. This causes violent fluctuations in the forward spreads and maturity gaps across the entire Forex market. If a multinational has millions of dollars tied up in long-term currency swaps or futures contracts, an unexpected interest rate hike can instantly alter the valuation of all their derivative positions. The interest rate risk directly affects the exchange rate.
Building on that complexity, we move to the third pillar, credit risk. This is refreshingly simple, but utterly catastrophic. It is pure counterparty risk.
Oh, counterparty risk.
The Forex market operates heavily on over-the-counter transactions. You are signing contracts directly with other institutions. You might execute a massive, brilliant currency swap that perfectly hedges your exposure. But when the settlement date arrives 6 months later, the institution on the other side of the trade simply declares bankruptcy and refuses to pay.
It doesn't matter how perfect your math was if the counterparty just vanishes.
Exactly. And the final pillar is country risk. This occurs when the macroeconomic problems within a specific nation become so severe that the government is forced to intervene directly in the mechanics of the market, effectively breaking the rules.
A classic scenario is a sovereign debt crisis, right? A nation realizes it cannot pay its international debts. Panic ensues, and foreign investors scramble to pull their capital out of the country. To prevent the complete collapse of their banking system, the government steps in and implements emergency capital controls. They freeze foreign accounts. They legally mandate that currency can only be exchanged at an artificial, government-dictated rate.
Right. And if your multinational has operational cash trapped inside that country, your funds are essentially frozen, regardless of what the open market exchange rate says.
So the CFO is staring down a gauntlet of transaction exposures, interest rate parity shifts, counterparty defaults, and sovereign capital freezes. How does a multinational possibly defend its profit margins against this level of multidimensional chaos?
They attack the problem in 2 sequential phases. First, they deploy massive resources to try and predict the future. And then, when they inevitably accept that the future cannot be perfectly predicted, they utilize complex financial instruments to buy ironclad insurance.
Let's explore Section 6, Exchange Rate Forecasting and Hedging. We will begin with the crystal ball.
The holy grail of global treasury management is accurately forecasting where exchange rates will be in 3, 6, or 12 months. The macro forces driving these rates are well documented. Shifting consumer tastes for imported versus exported goods, the comparative GDP growth rates of competing nations, the differentials in national inflation, and the central bank interest rate policies we just discussed.
The problem isn't identifying the variables. The problem is predicting human behavior. There are two deeply divided academic schools of thought on how to approach this.
Yes, the two schools.
The first is the efficient market school. This philosophy rests on the belief that the global forex market is functionally perfect. It assumes that the current forward exchange rates, the prices that millions of rational actors are currently negotiating for currency delivery in the future, already mathematically incorporate every single piece of available public information, economic data, and geopolitical rumor.
Right. And if you subscribe to the efficient market hypothesis, you believe that attempting to outpredict the collective wisdom of the entire global market is just an exercise in arrogance. Therefore, spending millions of dollars on proprietary forecasting models or hiring armies of macroeconomists is a complete waste of corporate resources. The forward rate is the objective, best possible predictor.
But the opposing camp is the inefficient market school. They look at the historical data and argue that the market is frequently wildly irrational. They argue that markets are driven by human panic, herd mentality, and algorithmic overreactions. Therefore, forward rates are often deeply flawed and biased.
And if a CFO believes the market is inefficient, they believe there is alpha to be captured. They believe that by investing in superior forecasting, they can build a more accurate model of the future than the market consensus, allowing them to hedge their currency exposure far more cheaply.
And if a multinational chooses to invest in that forecasting, they generally employ two vastly different methodological approaches. This is a critical area of analysis for your coursework. The first approach is fundamental analysis. This is the rigorous, deeply academic method. It relies on the construction of massive, complex econometric models based on established macroeconomic theory.
A fundamental analyst looks at the structural realities of a nation. They meticulously track the growth rate of a nation's money supply. They calculate purchasing power parity by tracking inflation differentials. They dig deep into the national balance of payments, analyzing exactly how much capital is flowing in via exports and foreign investment versus how much is flowing out to pay for imports. They are attempting to calculate the true intrinsic value of a currency based purely on the physical health of the underlying economy.
They believe that while the market might be irrational in the short term, over the long term, currency values must mathematically align with their economic fundamentals.
Right. Now, let's contrast that with the second approach, technical analysis. This method completely ignores the underlying macroeconomics. A technical analyst doesn't care about the money supply, inflation, or the central bank. They look exclusively at the historical price movements and the trading volume of the currency itself.
They are looking for patterns. They analyze complex charts, looking for moving averages, resistance levels, and momentum indicators. Let's inject some friction into this, though, because technical analysis often sounds dangerously close to reading financial tea leaves. If I am the CFO and my mandate is to protect $1 billion of international operating cash flow, am I seriously going to base my hedging strategy on the fact that a squiggly line on a chart formed a head and shoulders pattern? It feels fundamentally divorced from reality compared to rigorous inflation data.
It is a highly controversial approach, and your skepticism is warranted. Technical analysis relies on one rigid underlying assumption: that past market movements and human behavioral patterns inherently repeat themselves. If a currency's price dropped to exactly 1.05 three separate times over the last 5 years and immediately rebounded every time, technical analysts assume that 1.05 represents a psychological floor of support that the market will stubbornly defend again.
But why would that psychological floor hold in a market driven by algorithmic trading?
Because of the self-fulfilling prophecy. If enough massive institutional traders, hedge funds, and algorithms all look at the exact same chart and they all believe that 1.05 is the absolute floor, they will all aggressively start buying the moment the currency hits 1.05. Their collective synchronized buying action is exactly what causes the price to rebound. Is it a flawless mechanism? Absolutely not. A sudden geopolitical shock will shatter a chart pattern instantly. Which is exactly why no responsible multinational relies solely on technical analysis. They use it as a secondary, short-term timing tool to complement their long-term fundamental analysis.
And more importantly, they recognize that all forecasting, whether fundamental or technical, is ultimately just an educated guess, and you cannot protect a balance sheet with a guess. You protect it with a legally binding contract. This brings us to the ultimate defensive maneuver, hedging.
To define it mechanically, a hedge is a deliberate financial action taken specifically to reduce or eliminate the risk of adverse price movements. The most fundamental way to do this is by taking a precisely offsetting position in a related financial instrument.
Now, on a macro level, we mentioned earlier that simple geographic portfolio diversification acts as a baseline hedge. But when a CFO is staring down a specific 50 million euro transaction exposure that is due in 90 days, broad geographic diversification doesn't help at all. They need a surgical tool.
For your analysis, you must deeply understand the mechanics of the big three tactical hedging instruments. These are the tools CFOs use to manufacture financial certainty. Let's dissect the first tool. Forward contracts.
Okay, forwards.
A forward contract is an over-the-counter agreement. It is a highly customized private contract negotiated directly between two parties, almost always the multinational corporation and a major commercial bank. The mechanics are straightforward. The two parties agree today to buy or sell a highly specific amount of foreign currency at a strictly fixed exchange rate on a very specific date in the future.
Let's run the numbers on this to see the protection in action. Our American aviation company owes 50 million British pounds in 90 days. Today's spot rate is 1.0. The CFO calls their bank and negotiates a forward contract. They agree that in exactly 90 days, the bank will sell the company 50 million pounds at a locked-in forward rate of 1.02.
Okay, great.
The CFO doesn't care what happens in the open market anymore. If the pound skyrockets to 1.20, threatening to wipe out their margins, it doesn't matter. The bank is legally obligated to hand them 50 million pounds at the contracted rate of 1.02. The CFO has successfully transformed an unpredictable, volatile variable into a fixed, predictable cost. The transaction exposure is completely neutralized.
Exactly. The brilliant advantage of a forward contract is its infinite customizability. The CFO can specify the contract down to the exact penny and the exact hour they need the funds. However, that customizability comes with a massive drawback: extreme illiquidity. Because the contract is completely bespoke, it is incredibly difficult to sell to a third party if the multinational's business plans suddenly change.
Which perfectly transitions us to the second hedging tool, future contracts. A future contract is functionally designed to achieve the exact same goal as a forward locking in a future price. But and this is a critical structural distinction, futures are exchange-traded instruments. They are bought and sold on public, regulated exchanges like the Chicago Mercantile Exchange.
Because they must be traded rapidly by thousands of anonymous participants on an exchange, they cannot be customized. They must be highly standardized. A futures contract dictates a specific, non-negotiable block size of currency. For example, blocks of exactly 125,000 euros. And they expire only on specific, standardized maturity dates, typically the third Wednesday of March, June, September, and December.
So if our CFO needs exactly 1,432,000 euros on October 14th to pay a specific supplier, a futures contract is mechanically incapable of providing a perfect, seamless hedge. They will have to overhedge or underhedge based on the rigid block sizes, and they will face a timing mismatch regarding the maturity date.
Furthermore, because futures are exchange-traded, the exchange mandates strict counterparty protection. The multinational must post initial margin collateral just to open the position. And if the market moves against their position, they will face daily margin calls, requiring them to physically pump more cash into the exchange account to keep the hedge alive. This creates an ongoing drain on the firm's working capital that forward contracts simply do not require.
So, forwards offer perfect customizability but zero liquidity. Futures offer perfect liquidity but rigid standardization. But both of those instruments share one fundamental, terrifying flaw. They represent a legal obligation.
Yes, I do.
Once you sign a forward or buy a future, you are locked in. You have eliminated the downside risk of the currency moving against you, but you have also mathematically eliminated the upside potential if the currency moves massively in your favor. This brings us to the third and structurally most fascinating hedging tool, options.
Foreign currency options fundamentally alter the risk geometry. When a multinational purchases an option, they pay an upfront, non-refundable cash fee, known as the premium. In exchange for that premium, the purchaser acquires the right, but absolutely not the obligation, to exchange a specific amount of currency at a predetermined price called the strike price on, or before a specified date.
Let's use an analogy to make the mechanics of an option crystal clear for the exam. Imagine you are planning a massive corporate retreat a year from now. You find a perfect hotel, but you are worried hotel prices across the city are going to double by next year. So you pay the hotel a $10,000 non-refundable deposit today to lock in a guaranteed room rate of $200 a night.
Smart.
If a massive convention comes to town and hotel prices skyrocket to $500 a night, you are perfectly protected. You exercise your right to use the locked-in $200 rate. You successfully eliminated your downside risk. But what if a severe recession hits, and next year, a luxurious 5-star hotel across the street drops their price to $50 a night?
Well, because you only bought an option, you're not legally obligated to stay at the first hotel.
Yeah.
You simply walk away. Yes, you lose your $10,000 premium, but you are completely free to walk across the street and capture the massive upside of the $50 rooms.
That is the exact mathematical power of a financial option. It provides an asymmetric risk profile. Your potential losses are strictly capped at the premium you paid up front. But your potential gains, the upside, remain theoretically unlimited. You are literally paying cash for the privilege of choice.
And in the chaotic, unpredictable world of international finance, having the structural flexibility to simply walk away from a bad position is an incredibly valuable asset.
All right, we are entering the final phase of our analysis. We have successfully modeled the global capital network. We optimized our debt-to-equity ratio. We mitigated the sovereign risk in our NPV calculations. We utilized ADRs to raise capital efficiently. And we have now deployed a sophisticated matrix of forward contracts and options to completely neutralize our transaction and operating exposures. The multinational is a fully armed, heavily shielded financial juggernaut.
An absolute juggernaut.
There is only one ultimate macroeconomic strategic decision remaining for the board of directors. Where on the globe do we actually deploy this capital to maximize our return? This is the grand tug of war for investment. We must examine the fundamental dichotomy between emerging and developed markets.
This is where financial management intimately intersects with global macroeconomics. The flow of foreign direct investment FDI is constantly shifting back and forth between these two spheres based on the global appetite for risk versus yield. In the decade immediately following the 2008 financial crisis, central banks in the developed world slashed interest rates to practically zero.
Right.
Investors, absolutely desperate for any kind of return, triggered a massive tsunami of capital flowing out of the stagnant West and pouring into developing nations.
But the textbook notes that these macro tides are slowly shifting. As the global economic paradigm evolves, we are seeing the growth distribution rebalance, making developed economies highly attractive destinations for capital once again. To analyze a multinational's deployment strategy, we need to clearly contrast the structural architectures of these two environments. Let's define the developed markets first. We are looking at the highly industrialized, mature economies, the United States, Western Europe, Japan.
The primary attractive attribute of a developed market is the entrenchment of safety. These are massive, deep, highly liquid economies. They possess an incredibly high degree of political stability. But most importantly, the rule of law regarding property rights, intellectual property protection, and contract enforcement is absolute and historically tested.
If your multinational signs a 10-year supply contract in Germany, you have absolute certainty that the German legal system will uphold that contract. The risk premium required for your NPV calculation is remarkably low.
Exactly. However, that safety comes at a cost. Developed markets are mature, their populations are aging, and their domestic consumption is largely saturated. You are not going to see 20% year-over-year organic market growth in Western Europe. You are fighting brutal wars of attrition for single-digit market share gains.
Now contrast that mature safety with the explosive potential of emerging markets.
Emerging markets are developing economies experiencing rapid, ongoing industrialization and urbanization. We are talking about nations like India, Brazil, Indonesia, and Vietnam. Their attractive attributes are entirely driven by future potential. They offer incredibly high expectations for macroeconomic growth. They possess profoundly favorable demographics, massive young populations rapidly entering the middle class and driving explosive domestic consumption.
And they often have relatively low national debt levels compared to the heavily leveraged West, and they offer massive opportunities for productivity gains as they rapidly leapfrog legacy infrastructure and adopt advanced technologies.
Right. But the risk premium is massive. The regulatory environments can be opaque and subjective. The political stability can be fragile. And the currency volatility, as we just spent 20 minutes discussing, can be violent.
So this presents the ultimate strategic dilemma for our CFO. Do you deploy your hard-earned $2 billion into the safe, deeply entrenched, but incredibly slow-growth environment of a developed market? Or do you hurl that capital into the explosive, demographically driven, highly volatile consumption of an emerging market?
The answer lies in the fundamental principle we established at the very beginning of this deep dive. A sophisticated, globally dominant multinational does not view it as a binary choice. They view it as an exercise in portfolio diversification.
Ah, full circle.
They deliberately construct a globally balanced portfolio of operations. They utilize the massive, predictable, stable cash flows generated from their operations in developed markets to systematically fund their high-risk, high-reward expansions into the emerging markets. They engineer a corporate structure where the safety of the West subsidizes the growth of the East, and vice versa.
They balance the global equation. And with that equation balanced, we have successfully mapped the entire terrain. If you are preparing for your exams, take a moment to review the mechanical frameworks we have built today. We did not just list definitions, we traced the actual physical flow of surplus capital from European pension funds into complex American derivatives and analyzed how that sparked global contagion.
Yeah, we dissected the linguistic logic of separating foreign bonds from euro bonds. We stepped into the shoes of the CFO, adjusting the WACC to mathematically account for the threat of sovereign expropriation.
We bypassed the friction of foreign exchanges using the depository mechanics of ADRs. We navigated the treacherous differences between a short-term transaction cash loss and a long-term operating exposure. And finally, we built a defensive shield utilizing the bespoke contracts of forwards and the asymmetric upside of options.
You are no longer looking at a dense textbook chapter. You are looking at a dynamic, interconnected machine. You understand the physics of how a multinational corporation thinks, how it moves capital across borders, and how it deploys mathematical strategies to defend its margins against global chaos. If you hold on to those mechanical frameworks, the exam questions will simply be variations of the scenarios we've already solved.
Before we officially sign off, I want to leave you with one final provocative concept to push your thinking beyond the current syllabus. We spent significant time detailing how multinationals attempt to forecast exchange rates using fundamental macroeconomic data and historical technical charts. But consider the velocity of the modern technological landscape. Global markets generate billions of data points every single second.
Oh, absolutely.
We are rapidly entering an era where massive, proprietary artificial intelligence algorithms are not just reading charts. They're instantly digesting global news sentiment, satellite imagery of shipping ports, and real-time social media trends, executing thousands of hedging trades in fractions of a millisecond.
It raises a profound question about the future of financial management. In a hyper-accelerated, AI-driven market, will the traditional, human-calculated forecasting methods we study today become entirely obsolete? Will the ultimate defense against foreign exchange risk cease to be a forward contract negotiated by a human CFO and instead become a constantly adapting autonomous AI algorithm managing the firm's treasury in real time?
It is the next evolution of the three-dimensional board. The laboratory of global finance is only going to get faster, more complex, and more automated. The frameworks you master today are the foundation you will need to navigate that future. Thank you for joining us on this incredibly deep dive into the mechanics of the global market. Trust the frameworks you have built, rely on your understanding of the mechanisms, and good luck on your exams. We will see you next time.